Hi, this is Peter with Wagyu Realty again. Thank you again for watching our channel. So last time we talked about rental properties. We did some very basic math. We got into what are some of the expenses. We have two new terms: net operating income. In our example, $400,000 property value. The rent is $2,500 a month. And the NOI, we agreed that it will be $15K a year. So every year you make $15,000 of net operating income. And we set the cap rate is 3.75%. If you don't know what I'm talking about here, check out my last video or e-newsletter, and all the numbers will start to make sense. And if it still doesn't make sense, contact me and I'll make sense of all the numbers for you. So today, after we know all the basics, we're going to talk about projected return on the investment. When you look at the cap rate, 3.75 is not that good. Just because if you put your money in the bank, you get maybe 1% now, maybe a little bit more than 1%. I believe as the time being, the 30-year bond, it's a little over, around 3%. So 3.75 is not that good. So why invest in real estate? Historically, real estate appreciates in value. In Bay Area, even with the downturn of 2007, if you do backtrack 50 years, it still go up about 5% a year. Consumer price index is about 3% a year. Let's not deal with 5%, and well, Bay Area 5%, nationally about 3%. And that's kind of the consumer price index. As everything else go up in value, gasoline, commodity, apples, oranges, houses go up in value too. And it's about nationally 3%, real estate in Bay Area 5%. Let's use the national average of 3%. So 3% of $400,000 is $12,000 a year. Okay, so that already makes the math a lot better. Instead of 3.75%, now it's kind of almost double, right? Let's say 6%. What else? What else is there? What else are the advantages of owning rental property? Depreciation is another one of them. So according to the law, if you take out the land value, the building value of the property, you can use 27.5 years to depreciate it, and the amount that you depreciate, you can offset it with your income. Let me show you how it works. Well, for example's sake, 1/3 of it is the land value, 2/3 of it is the building value. So 400,000 times 2/3, which make it the building value, and then you can depreciate the building by 27.5 years. Okay. So 400,000 times 2/3 is, where's it in the notes? Okay, it's 268,000. And then if you divide it by 27.5, you get 9,745. And this amount, you can offset your income with it. Whether or not it is the net operating income from the real estate itself, or if the property doesn't generate any income, it can offset your regular income from your work. So assuming you're in a 33% tax bracket, pretty typical, 22% federal, 11% state income tax, then you get, if you multiply by 33%, right, of tax rate, you get 3260. Okay. A caveat for depreciations: when you sell the house, you do have to recapture it, and there are ways to not ever pay the depreciation recapture. I mentioned 1031 exchange before. If you want, I can shoot me an email. I'll send you that video. There are other ways to either prolong not paying it forever, or to minimize it. So there are other ways to do it. If you want, just talk to me. I'll tell you more about it. So it's already gone from 15K to 27K to now close to 30K, right? Well, more than 30K. And there's one more. I just heard it 2 weeks ago, so I haven't done all the detailed research on it yet. It's a new tax law from Donald Trump administration. It's called 199A. 199A, which say that for business expenses, 20% of the business expenses, net business expenses, 20% of the net business income do not have to pay tax on. You heard it right. So talk to the CPA. I'm not an expert on it. All these math, I can give you general idea, but CPA and lawyers, they call the shots, okay? So 20% of the income you don't have to pay tax on if you fit the mold. And the mold is a little bit complicated. So if it passes, then you get a little bit of tax saving. If you don't pass as a landlord, then you have $1,000 less, basically, from this example. Let's do the math first, and then if you want, shoot me an email. I'll do some research on it, and I'll do another video. So we have $15,000 net operating income, and we have 20% that we don't have to pay taxes on, which is $3,000, right? And assuming you're 33% tax bracket again, this translates to $1,000 tax saving. Okay, so together we have $15,000, we have $12,000 from the appreciations, we have $3,216 for the depreciations, appreciations, and then the new 199A tax saving. If we add them all up together, we get a number of 31,216, which is a lot better than the $15,000 number. And the projected return of investment becomes 7.8%. So this is a lot better than that number. And in the next video, after we introduce the mortgage concept, the number will look even better. But until next time, thank you for watching.